Financing Fridays. And I'll give you one more outgoing question, and that is related to financing. And you mentioned some financing stuff, so you could either answer this one of two ways: the creative financing that you've done that's been interesting that people can learn from, as you did in your last deal, or you could just tell us what you're doing today with financing to overcome some of these challenges.
Yeah. So that's a great question. I'll try to go down a road here that might be a little bit more relevant from like a current events kind of standpoint. And
Sure.
Not sure when this is going to get released, but I imagine the macro situation here with the real estate market is probably going to be pretty similar. It's really hard to get deals financed right now, and as a quick little data point, for example, back in 2022 or 2021, when we had a deal under contract and let's say it was a 20 unit deal, it was right down the fairway of what we typically buy in a good area. Financials are fine, assuming that there's no weird variables. That's a deal if we took it to 15 banks, local credit unions, which is who we primarily use for financing on the buy side. We would get 15 term sheets, right? Every single one of them would write a term sheet, and 10 of them probably wouldn't be competitive. 3 of them, we're close. 2 of them, pretty good. And we'll go negotiate with those 2 banks and find the best, rate and terms. Now, if we took it out to those same 15 banks, we're probably getting 5 term sheets. We're getting 10 that are like, we're just, like you, we've worked with you. We appreciate you bringing this to us. You have experience. We're not worried about you as the investor here, but we're just not aggressively lending on these types of deals right now. That's the feedback that we get from a lot of banks. So there's a lot that are just simply not writing term sheets. And then the ones that are writing term sheets are oftentimes including worse terms, naturally. High rates has made the in-place debt service coverage ratio at the time of purchase when you're buying a value-add deal extremely challenging to overcome. And it's constraining leverage, which is probably something that most people are familiar with that are in this space. So we still have a few local banks and credit unions that we have long relationships with in terms of doing like a dozen loans, and they're still coming back. And banks are becoming really, really sponsor and investor oriented in terms of who the individual is that's actually personally guaranteeing the debt, 1, in their personal balance sheet, and then 2, who's actually going out there and operating the property and running the deal. So I think that in general, we've really narrowed down the number of banks we work with. And then if we're in a really hairy deal and we can't really go the traditional financing route, we still do go the bridge route. I'm very hesitant to do that nowadays, and I'm really only interested in doing that on deals that either I'm personally buying or that I'm buying with 1 or 2 key partners that have a level of understanding around the business and a level of risk tolerance that they're cool with an 18-month loan product. And typically we're only doing that with deals where we have real big margin. This deal in Raymond I just mentioned was an example, that 15 unit. We kind of had to go that route because we couldn't really go through the traditional appraisal process, et cetera, because we couldn't really access the units. So long story short, I mean, that's what we're doing now. And then we're also very heavily pitching seller financing to owners. So again, we do a lot of direct to seller. We're typically presenting 2 offers or even 3 offers. One is, this is the offer this is the price that we'll pay for your property. We're going to go out there. We're going to secure our own financing. But here is this offer, assuming that you hold 70%, 75% of the purchase price back. And we typically, use kind of market terms around the debt, 5% interest only, or I shouldn't say market, but slightly more competitive terms around the actual debt. 5% interest only payments. We'll do a 3-year term, maybe a 1-year extension option at like a higher interest rate, so you're compensated for that. And then we just gauge their interest. Now, the vast majority of sellers aren't interested in doing seller financing because the reason they're selling is they want to take their money and they want to go buy their boat in Florida and hang out. But sure, we still have that conversation. We still pitch it as a potential option. And we're seeing a slightly higher percentage comparatively to a few years ago of sellers that are willing to entertain that. We have one deal right now that we're under contract that's a seller financing deal. And we're working on another one and we expect to get under contract tomorrow. So knock on wood. But that's a $1.8 million deal where the seller's going to hold back $1.5 million for, 24 months. So a couple of years, then we got to pay it off. So
that's a large percentage.
We are starting to get some level of traction there. But in general, it's still predominantly driven by local bank debt because
It was all good. It was all good. That's why you're our Granite State rock star, Axel. You give me all kinds of good stuff to think about. Anybody who listens to this that plays in this area, especially below the 100 units, they could just dissect this and pause and listen, and then go to your Multifamily Wealth podcast and learn a bunch more. Where else can they reach you? You mentioned it, right? Host of the Multifamily Wealth podcast, coming up on 250 episodes. We've been cranking it away for 5 years now. 30,000 monthly listeners. We have a lot of folks listening to it. So if you like if you like multifamily and you want to learn more about multifamily, go check that out. You can follow me on Instagram. I'm very active on Instagram at Multifamily Wealth. And then if you just want to reach out to me, Axel, AXEL at alignedrep.com. So ALIGNED rep.com. Excellent. Thanks again, Axel. It's always good talking to you. I'm glad you took some time today to hang out with us, and I'll let you go. Hey, thanks for having me on. If anybody else wants to find out more about what we're doing, please come to froggycompanies.com. Check out our 3 different business areas. We also have the Froggy Fund 1 that's now open for up to $18 million. We're going to be investing that $18 million across a diverse number of assets, cash flowing and ground up. And I'm really excited about this fund and really confident that we can outperform most of the other people out there in terms of what we invest in and how we do our due diligence and the type of partners we put together. So it's great talking to you, and see you next time.